Fund Supermart, your online gateway to unit trusts.
Can you share what are quant strategies? What is the difference between a traditional quant strategy and one that integrates environmental, social, and corporate governance?
So quant strategies are funds which use a systematic approach to investing. One can differentiate between so-called discretionary funds, where the portfolio manager can just act based on their intuition or whatever they think is right or wrong, and funds which are more based on rules and clear guidelines. The quant fund will use systematically information from the market. So we, for example, screen and process 100 billion data points. So one data point would be the close of an Apple stock, or the opening of a Google stock, or the volatility or other market parameters. So obviously in this time and age, information is critical, and no portfolio manager can process those information anymore systematically. So what we simply do is understand the cognitive process, whatever happens in the thinking of a portfolio manager, research it, program it, and make it systematic. This is a quant fund based on quantitative models. An ESG quant fund is a specific element of that, which uses, in addition to financial information, so-called non-financial information. So how do companies perform on their environment, on social or governance issues? This is not necessarily for ethical reasons, but also because it generates performance. So how does a company go about their wastewater management? How much electricity, water do they consume compared to their peers in their countries? How is the governance structure? How do they treat minorities? How is their commitment to safety and security? Or how is their doing on the governance side, on the control side? So these factors add to the performance, and it helps you to avoid bad investment, such as Volkswagen, Toshiba, BP, or other scandals that had occurred, but in our case have all been avoided because of the ESG screening of the quant fund.
Why adopt quant strategies, and what are the benefits and disadvantages of these strategies?
So the key two benefits are A, that you can systematically process a lot of information, and B, that you can remove the human intuition. So humans obviously tend to be emotional, cyclical, so we have good days and bad days, which is not necessarily positive for the investment process, because you might be under stress, or you might be optimistic, or you might be euphoric, or you might be, subject to your emotions. And this is never a good thing with investing. You need a stable, consistent process. As an investor, you want to say, these are the rules, this is the process, you have to follow it, and you eliminate any surprises or disadvantages. Now, the problem with that is that if there is an unexpected event, so for example, a certain conflict or some news that occurred, the computer can't pick that up. The information is just not there in time. In that case, we have an overruling process. So there's an investment committee that can step in and overrule the system. But this is a very clear, defined parameters. For example, we had the Ukraine crisis last year, and Russian stocks were banned. The investment committee stepped in, overruled the system, and removed all Russian stocks. So this is a classic example. Other than that, it is like in all kinds of life, in our day-to-day experiences, where computers and technology just help us to do a better job. In airplanes, for example, in the 70s, the pilot would fly the plane aided by the computer. Today, the computer flies a plane and the pilot overlooks it, steps in if he has to. But no human has the capacity anymore to fly as good as a computer can. In chess or in Go, a computer beats a human simply because it can process more information faster, anticipate more moves ahead. And the same happens in the investment process. Computers are just key to a successful portfolio management.
One aspect of quant strategies is they predict future events, but it is impossible to predict the future every time. What is your opinion on this?
You're absolutely right. Nobody can predict the future, and also a quant model would not do that. However, what it will do is It will use information to anticipate certain things, and it will risk manage it. So just look at the current market environment and assess, for example, how much money should you risk? Are the markets more volatile? Then you should take risk off. If the markets are friendly, you should put risk on. And also there are basic rules about market trends. So if a stock, for example, is uptrending, it is more likely than not to continue uptrending. If the market is downtrending, it is more likely it continues until the trend is broken. So in a computer model, what you can do is you can optimize that scenario and you can build your portfolio accordingly. But to be very clear, no model can predict the future. You're spot on.
Can you explain how Arabesque Asset Management takes advantage of the environmental, social, and corporate governance factor in quant strategies?
So that is a very big trend. So many big companies, Morningstar, Morgan Stanley, Goldman, Deutsche Bank, talk about a mega trend in finance. And what they mean by that is responsible investing, responsible finance, or the US calls it environmental social governance, or ESG investing. So historically, we looked only into financial information. We try to assess a company based on its performance in terms of sales numbers, revenues, costs, and so on, its innovation. But we did not consider how do they deal with the environment, so how do they go about water consumption, energy consumption, the production process, how's governance and control mechanisms of the firm, how is it the social aspects of the firm, how do they treat minorities, how do they allow women to make a career in the firm, be equally paid like men, and so on. So this is the new trend in investing, where it's not just about how much money will you make for me. It's also about how has this money been made. Is it at the expense of child labor, corruption, pollution? Then it's not sustainable. Investors now demand not just a return, but a sustainable return. And ESG helps you to create sustainable returns.
How frequently does your team add new aspects to the models?
So the model uses artificial intelligence and recalibrates itself ongoingly. So it assesses what is the best time frame to consider in order to make assessments on the future. So with the first statistical or quant models, what you had is you find an anomaly, and then that goes for maybe 3 or 6 months, and then that anomaly goes away, and then the model doesn't work anymore. That was the older systems. Our technology is a self-calibrating system, so it permanently learns, it optimizes itself, and it takes steps out of that for the investment process. However, in addition to that, we permanently research new aspects. We worked, for example, with Oxford University on a project called From the Stockholder to the Stakeholder, where we analyze the correlation between a company's performance on non-financial information, ESG information, and the stock price of the company. And where we find a positive correlation, we implement that into the portfolio. So a company that is, for example, conscious on the environment, we show that it will outperform over time, and we research it and implement that into the portfolio.
Due to the complex nature of the mathematical and statistical models, is it difficult to find talent?
It is actually not. It is a real pleasure. We have a significant amount of academics and talent, starting with our chairman, who is Professor Bob Eckes from Harvard University, the founder and leader in the integrated reporting space. So integrated reporting is what you need in order to assess a company in the non-financial space and put that into your portfolio. We are partly owned by one of Germany's largest think tanks called the Fraunhofer Society. It is the conglomerate of German universities for applied science. We work very closely with Stanford University, with Cambridge, with many other good universities that can supply us, and particularly the younger generation loves that and has a passion for finance in an ethical way, in a sustainable way. So far we've been quite all right.
Any criteria for these students or from Oxford or any university?
So we have a saying that is a quote from Beethoven, where we ask our people, don't just practice your art, but force yourself into its secret. Be a perfectionist. Try really to understand what you're doing and do it with love and passion. And then you're more than welcome to join us. So it's less about what you have studied or what's your background. It's more about how you do it and that you try to do it to perfection. That is how we try to build the team.